Good afternoon. This is Bart Walker from McGuireWoods. I'm a partner in the healthcare group here and have been for as long as I can remember. Thank you for joining us for today's webcast on a primer for sellers on dental and DSO transactions. I see a lot of familiar faces on the attendees list, and as you all know, our firm is very active in this space and have been for quite some time. So happy to share with you some of our insights on what is happening in the DSO world, in particular with respect to the transactional market, and hopefully some practical advice for sellers, or more specifically looking at things from the seller's perspective, which I would suspect would be beneficial for both buyers and sellers. So we're delighted to have with us a special guest, Kurt Harvey from Caber Hill Advisors. He had recently just joined Caber Hill in 2019 and previously had been with Great Expressions for over 11 years, where he headed up a lot of their expansion and M&A activity. He brings a wealth of information to the conversation, particularly on the business topics. While we have a lot of exposure to the business side of things as M&A and transactional lawyers, we are not nearly at that level of detail that folks like Kurt are. So we're delighted to have him with us. Again, my name is Bart Walker. I'm a partner with McGuireWoods in our healthcare group. Kayla Marty is one of our superstar associates who really runs things around here, has been instrumental in growing our dental practice and our healthcare transactional practice. I think, as a lot of you know, McGuireWoods is 1,000 lawyers nationwide, international, and one of the top healthcare practices in the country in terms of number of healthcare lawyers. We represent private equity funds, DSOs, lenders, and other healthcare providers, primarily in healthcare acquisitions and M&A, but also as outside general counsel. So we see these types of transactions from all different angles, depending on the deal, which we think gives us a good perspective on industry trends and generally what market is in these types of transactions. Okay, here's our agenda for today. There are 4 real topics that we want to cover. I will say, as an initial matter, if you've got questions, there is a Q&A console here. Feel free to type in your questions, and we will try to address those as they come up topically. If we don't get to your question, or if it's just too specific to be broadly applicable, we will follow up with you after the fact, but we will try to make this a little bit more of a dialogue. So if there are specific questions you've got, feel free to ask them, and we'll try to address them as we go through. In terms of the broad agenda, there's really 4 topics here. One is just an overview of the current climate for dental practice transactions. What is it like out there? It's been a crazy year or trailing 12-month period going back to last March, really, and we've seen a ton of disruption. We've seen a ton of chaos caused by the pandemic, which has had varying degrees of impacts. So we'll try to unpack some of that and then give you an update on what we're seeing today, in particular as it relates to potential tax changes on the horizon, which tends to drive a lot of uncertainty and, as a result, M&A activity. Second, we'll talk about some pre-transaction considerations and preparation you can do if you're a seller or you're looking to do a transaction or a combination. What are some of the things you need to be thinking about now before you go to market? Third, we'll give you some strategies for preventing transaction process issues. How do you anticipate hiccups and bumps in the road and try to smooth those out? And then finally, we'll talk a little bit about operational considerations in a transaction, in particular, sort of nuts and bolts and on the ground things that you need to pay attention to throughout these processes. Okay. So with that, let me turn it over to Kurt. Kurt, if you want to kick us off on just an overview on the dental transaction climate, I'm sure Kayla and I will have some things to add and probably some questions for you as well. But if you want to kick it off, I'll turn it over to you.
Yeah, thank you, Bart. Thanks for having me as well. Definitely appreciate joining you and love to talk about these topics. You know, as you said, I'm with Caber Hill Advisors, managing director there, and concentrating on dental right now. Really just kind of unleashed, I guess, myself on this on the sell side to help entrepreneurial doctor groups. Kind of our like my specialty is anywhere sort of from 1 million EBITDA to 7 million EBITDA. So somewhere between, and same with Caber Hill and our different verticals, but between kind of your broker that a single practitioner is typically used to, which there's a lot out there and have been for a long time, and for a long time it was just doctor to associate, and then between like the larger investment banks that handle the 10 million EBITDA plus transaction. We saw a real gap there to professionalize it and just give support. And Maria Malone actually joined us from the East Coast earlier this year too. And we both have DSO backgrounds for many, many years. I went from the original founder through 3 rounds of private equity, so successfully. So I have a pretty unique perspective to bring to selling doctor and selling doctor groups, and really having been on the other side and worked for 3 different private equity groups in that climate, and just really know how do you operate within that too. So I can bring a lot of perspective very early on, versus just a siloed approach to just getting you to close. I can really tell you about how it is afterwards too. So that kind of leads into like a lot of the things that I'll say. So I'm happy to answer any questions, particularly that aren't on these that we go over as we go through as well, whatever is top of mind for our audience. So, but as far as the climate right now, I mean, with the pandemic last year, it was, largely, shut down in March, April, May, come back in June. A lot of places were mid-March, and then you came back kind of June 1st. Varied by state. But really, it did put a quick halt for a little while. You could there were people buying that were already in the process, like LOI stage or close to that. And so they continued to get those deals closed. And largely, there wasn't much effect on the valuations themselves at that time. It might have shifted a little bit more to like earn-out or contingencies to make sure that people got back to the levels that they're at. I mean, these are priced off of EBITDA. At the end of the day, earnings before interest, tax, depreciation, and amortization. And then beyond that, the definition expands depending on who you're talking about into one-off items, non-recurring, all different types of stuff. And so that's, for those that aren't that familiar, that's how you can get so many different numbers of EBITDA depending on who you're talking to. But in my mind, it's supposed to represent the ongoing cash flow from the operations that you're going to continue to get each year, each month, that you can then use to reinvest in capital, distribute to yourselves, and do that. So, but the valuation shifted a little. There was a little bit of a pause between, after that, well, people were trying to figure it out. But, what I will say, dental has, there's over 190,000, individual practices. And, the American Dental Association has a lot of members. And then, some software companies out there like Sika, they're tapped into like 30,000 systems around there. So they got really good data between the ADA and Sika to really track, the trends. And, most of the industry came back fairly quickly to, somewhere between 80 to 90% of what they were doing historically, pre-COVID. And that, and what I'll say, a lot that I had experience with that really concentrated, kind of just didn't, hit pause, but really looked back at their business, took it as a time to reevaluate things, and, just really like tried to open back up, reached out to the patients, communicated. A lot of those came back fairly quick, to 100% of what they were pre-COVID, if not more. And that, that rebound is there. Right now, most buyers, if you're looking at it, they're not looking at, that COVID period anymore, or it's getting into, if you enter into something right now, it'll be a few months before you get an LOI or 2 months. So you're kind of getting out of that period. But most buyers will, as long as you're tracking and you came back to good levels and you've got a good run rate over the last 9 months, say, then they're going to kind of ignore the COVID period from a valuation standpoint and it's shifting back to kind of full valuations as they were pre-COVID. And what I will say is it seems to have just, there was a lot of interest in dental before. I mean, there's, 75, 100 very active, larger DSOs that are acquisition models, buying groups, buying singles, buying a lot of things. So, they just took a pause, but, they got money to put to work and they want good partners. So, they came back pretty quick. And then there's, 9,000 plus private funds out there, which 10 to 15 years ago was like a tenth of that. So there's so much money sitting on the sidelines of other people trying to get in. And what I've seen is a lot of that private equity, family offices, funds has started coming down to, or hasn't just started, it's been for a while, but much more to like a, 5 practice group doing a couple $1 million of Ebitda that has some growth potentials. Like you just didn't really have private equity looking at that level very much before, and now it's pretty prevalent. So as far as the seller goes, they have a lot of options, out there, but could also be, pretty overwhelming. So there are a ton of buyers right now, and I don't see that stopping. There's consolidation at all levels here. At the very, very large DSOs, depending on how you define those, but there's really like 10 or 20 of them, and some of the staple names that people really know. It's interesting, like Heartland, for example. They're basically a first to market as far as acquisition goes, going way back when. They've kept that advantage, largely doing singles and doubles, and they did some groups years and years ago, but a couple of them didn't go the greatest, and they openly, at a conference were saying like, okay, we're not doing groups right now, we're pausing. They added the de novo factor, so they really had 2 avenues of growth for a while, and they're very successful at both of those. But only recently, I'd say in the last year, 2 publicly announced ones. They bought True Family Dental, has 23 practices in Michigan and Chicago and areas, and they just most recently bought American Dental Partners, which is like 275 practices and sort of a legacy DSO that's been around, but it's kind of been, stalled in growth, kind of for a while. But, so that's a really big deal for them. And we also saw Smile Brands, early last year with Midwest Dental, buying that, and that had, a few hundred practices and stalled growth, I would call it, but a great platform that needed a good partner. So it's interesting. I wouldn't necessarily call ADPI in Midwest like the, marriage of like 2 just powerhouses. But it's an indication that we're going to start seeing some even more consolidation, even in the next year, 2 years, but definitely in the next few years, in my opinion, with some of the bigger, the bigger people out there, like a couple that are coming. And I always think, like, I just pay attention to where they're at in their hold period with private equity, because they got to put funds to work in over a 10-year period, usually on average have a 5-year hold period. And I know, like Aspen and Affordable Dentures is coming up to, kind of that period too. So it'll kind of be interesting to see, like, when they come to market and how that transacts, and be interesting to see if they actually potentially pair up with each other, because I think it would kind of be a match made in heaven for the 2 of them. But those would be huge deals.
Kurt, what are you seeing in terms of valuation multiples? Sorry to interrupt you, and this may be where you were going anyway, but just in terms of multiples of Ebitda, where are you seeing the market break down?
Yeah, it's interesting. Anytime I'm asked this question, I'm happy to share my opinions, but I also I can't help but say, it depends and caveat it, because, just like the old days with single practitioner, where they just talk percent of revenue on single practices and things because it was easy, or in real estate where you talk cap rates because it's easy. Same thing with Ebitda multiples, because there's so many things that can factor it. what I will say is, I've kind of seen them all going up. There's some pretty distinct, like size matters. So, 0 to $1 million of EBITDA is kind of like one category really. And those can kind of be anywhere from sort of, I'll say 4 to 6 times. And, the closer you are to $1 million or even like that $1 million to $2 million, in my experience, I've seen 5 to 6 times or 5.5 times. But, at the end of the day, people are borrowing off of this. And when you're smaller, you should only be levering up, like leverage, meaning with debt as a transaction, like 3 to 4 times, maybe 2 to 4 times. A lot of conservative groups might even only do 2. So they generally have about half equity, half debt when you're going into, well, certainly groups. So that has a factor. But when you're jumping into, kind of $1 million to $5 million, or really $2 million to $5 million, you're getting into sort of the 6 to 7 range. When you're getting 5 to 10 million, and actually, I'll say, if you have growth potential and you have a pipeline and you really have like an infrastructure, it doesn't even have to be huge, but an infrastructure set up a little bit for growth. These things are trading anywhere from kind of 8 to 9 times in that smaller size. Like if you have a handful of practices and a lot of growth opportunities and something a little unique, like, being a strategic fit really matters. Not everybody's going to pay you that price, but if you find the right partner and it really fits for them, yeah, you're going to get a pretty good price because it makes sense for them to, pay you a little bit more than, just anyone else because it's very strategic for them. So finding the right partner really matters. When you get over 10 million of EBITDA, you're kind of in a whole different ballgame. That's when you're starting to get into, double-digit growth or double-digit multiples. And so, I see that, continuing. I don't see those coming down. I do see people being disciplined, though. I mean, you got to be disciplined to an extent. I think there will be some people overpaying relative to, like, the opportunities that they have, and I hope there's not that much of it because I don't think that's the greatest thing for the industry long term. There's other things that really impact that multiple, though, too. Like the structure of the transaction is really important. So if you're kind of a cash-out king and, hey, I just want to be done, and you're, you have a partner or something and you're very critical to the business, well, you're not going to get those multiples. You're going to get less. But if you're all about growth and you're sticking around and or like the production and the revenue that's driving ultimately the EBITDA continues post-closing because you're not really chair-side yourself, then you can get, kind of higher multiples. But, 3 to 5 years ago, the structure was really like cash and seller notes. It was like an 80-20 split or a 70-30 split as far as percentage of like how much cash versus, seller note or some kind of holdback, which might be contingent on employment or just contingent on maintaining your revenue levels or something like that. Really, like for competitive deals now, it's almost become more the norm, especially in group deals, not like the singles, but the norm that, you got a portion that's cash, you got a portion that's equity, and a lot of times a portion that's some kind of an earn-out because it's a very competitive environment. A lot of the groups that are coming to market have growth potential or, have, did a de novo in the last year or acquired something and they've added people or, they redid the operatories and added another one. So they're trying to get credit for certain things. So I see buyers much more willing to kind of stretch on their valuations, but largely through more equity. So like with the sellers reinvesting or rolling over, 25 to kind of 40% of their proceeds, probably with the sweet spot of 25 to a third into equity going forward, so that the buyer, whether it's the DSO or a PE firm, like knows that they're aligned with the doctor group, and they get the right partner. They know they have growth. You know, you can do it better together, really. You take some chips off the table now and you get, you know, a second bite at the apple in 3 to 5 years, or, you know, which potentially leads to a third bite or onward. So, you know, that structure has become a lot more common and has somewhat, I don't want to say completely mitigated, but somewhat mitigated the doctor turnover risk, because, you know, for a while it's getting even more and more competitive to recruit doctors than, you know, 10 to 15 years ago. And so, you know, having key doctors aligned with you and committed is very key. So that structure really has taken hold. So, you know, if somebody just is like, no, I just, you know, there are some buyers that come in and they're like, I'm not willing to do earnouts, or I'm not willing to, you know, I want to pay cash and not share as much in the equity with the owners. Like, they're not usually winning deals nowadays, unless they, you know, find them proprietary, you know, and have a unique process.
Interesting. And has, in your experience, has that been, at least so far, an effective way to align economic interests and keep the stickiness in the relationship going forward?
Yeah, I believe it. I believe it has. You know, I believe as buyers, it gives them a lot more comfort. You know, sellers, it's good, but I think you really need to make sure you diligence as a seller, who's buying you. You know, don't think of that as a guarantee that your equity is going to increase. You know, there's some people that promise, like, oh, I'm going to give you 10 to 12 times, you know, return on your equity in 3 years. I don't think that's really reasonable. Like, if somebody says 2 to 4 times, then they're in more of the average and the norm and a viable increase. You know, some that are making bigger promises, I would stay away from them, even though it sounds great and sounds like a fantastic purchase price, because you're just showing them like all the money they're going to make 5 to 10 years from now. You know, you got to be really realistic with those growth projections, especially with it becoming just continually more competitive from an acquisition standpoint in the industry.
Sure. One of the questions we got from one of our attendees here is whether there's any kind of valuation discount or impact from Medicaid being a significant amount of the payer mix. I know at one point, from our perspective, gosh, about 10 years ago, there were quite a few kind of very notorious incidents, I guess you could say, of folks not doing the right thing around Medicare patients in particular parts of the country. I think that's largely been ameliorated, and I think the industry at large has done a really good job of making sure that those kind of things don't happen. There's always going to be bad actors in whatever industry you're in, but I think that was kind of one piece of it, and we had seen for a while that either affecting valuation or affecting people's willingness to jump into the dental space that has heavy exposure to Medicaid. But we've seen quite a few of those coming along now, especially models that are tailored specifically to that population and potentially other services they could offer to that population. So I would love to hear your perspective on whether you're seeing that impact valuation at all these days.
Yes, I think there is generally, you know, a view of discount to Medicaid, and it comes from a number of different forms, you know, just the risk level associated with it. You know, you comply, right? And there's operational barriers too. Like, credentialing is huge for one, and it takes, you know, 90 to 120 days to like credential a doctor under Medicaid, and in no way, shape, or form are you supposed to be billing under another provider like while that happens. So if you have turnover in your office, it can be really debilitating in a Medicaid practice. At the same point, you know, there's not as many people willing to consolidate in Medicaid. And, you know, if you do the model right, it can be very effective. And at the end of the day, you know, I'm sitting there going, this is where dental needs are, right? So I would love for it to, you know, sort of just kind of continue, like the patient base that, you know, tends to be with Medicaid. It can vary by state widely. There's some states where, you know, all kids basically are on Medicaid as well. So it's not necessarily just a sign of like lower, you know, lower class. demographic or lower middle market, or lower middle class, like demographic, just being on Medicaid. It can be different. But if you know what you're doing it right. I think a lot of the, bad apples out of there, you certainly have to diligence more and do that. You do not have as many like potential buyers for Medicaid businesses, so that kind of partly is the reason why there's a discounted valuation on it a bit. But what I will say is, it's becoming so much more competitive with sort of, the typical acquisition that a lot of DSOs are. I don't know how many I can't even count how many conversations I had where somebody talked to me and said, look, all I want is I want $1 million Ebitda plus. I want the doctors to stay. I want them to not be retirees, cashing out. I want, PPO a little bit, fee for service, and, I want a 35-40% hygiene program. I want everybody to, I want them to roll like 25% equity. And, my answer to that typically is like, okay, so help me understand, like, how are you differentiating yourself from everybody else? Because that you just defined everybody and their brother, basically, that is looking for these practice. Not a problem if you find them and you're willing to, because those go for a premium. You're willing to pay for those. Not a problem at all. Like you'll get some, but if you don't, if you're looking for something, like really try to look for a niche that differentiates you. And I think from a Medicaid perspective, like those that are willing to do it, a lot of people like to diversify states. So if they're growing, they're not just in one state, they're in at least 2 or 3, if not more, so that at least you mitigate risk to a certain extent, because it's state by state with Medicaid. And, you try to have mostly kids, because, it's pretty much political suicide to cut a kids program on dental. But, states have been more known to cut adult programs. But really it is a niche area that if somebody wants to, consolidate, they can. I mean, I heard at a conference, actually it was your conference in Chicago, Josh at Hero, like, on the panel I was on with him, he just said, like, I love Medicaid because I can keep buying this practice at reasonable values and I don't have a ton of competition. And that's true. Like, there just aren't a lot of people willing to do it. So it is a niche area.
Sure. I think at one time in the past, like I mentioned earlier, it was sort of a go, no-go feature, and now I think it's very much less so, and more of a nuanced question based on kind of the circumstances. Maybe one more question on valuation. We're getting a lot of great questions from the audience, and I want to try to honor as many of those as we can. Well, one maybe from a little bit different perspective. So what if they don't want to sell to a DSO, or what if they don't want to partner with a PE fund? What are the options? I know we've worked on a handful of those where it's been sort of a peer-to-peer DSO formation where dentists are getting together and forming their own regional or sub-regional to try to get to scale without outside funding. Have you seen any of that happening, either organically or through more of an orchestrated M&A effort by one major practice in a region?
Yeah, I have. I mean, I have seen that. There's a lot of, kind of entrepreneurial doctor groups that, for the longest time, for years, it was like, the dental industry was kind of very sour on DSOs. And, it's okay, that's a view, but it just took a long time for the industry to really, because in the 80s and 90s, the many DSOs just got together and imploded and went public and stuff. So there was a lot of lack of trust that DSOs were going to do things right. But generally, DSOs are doing right, for the most part. There's there's a few bad apples, but there's a few bad, single practitioners and stuff too, not doing great things. So I think that, but most are trying to do it the right way. They're trying to grow. They want it to stay. We got the ADSO. We got different organizations that are really trying to improve dental care and as part of the healthcare system overall. I think that portion is really good. So there's a lot of groups kind of, doctors getting together and, getting 2 to 3 practices together and then 4 to 5 practices. Where I see an inflection point typically is sort of about, kind of somewhere between 5 to 10 practices, depending on how you are, where it's like you can kind of, buy or manage these practices somewhat, and I'm talking regionally, not spread. So you're just in a, specific MSA or, a city area, metro area, and you've got these practices there. So, it's decently, you can manage it a bit. But now once you go from there to, 10 to 20 practices, like you're realizing like, I got to hire the back office, what the DSOs have. I got to hire the, controller, I got to hire CFO, I got to hire some more operations folks, like regionally, like I've got to, and or promote from within. But, the challenges become a lot different. It is at that point where it's typical to sort of look to bring in, outside equity. And to your question of, does it have to be a DSO? No, it does not, all depending on your goals too. I just had one recently in market, sat down, and at first they just said, like, I don't think I want to go DSO. And I said, well, let's sit down and talk about this, because there are a lot of good DSOs out there that really can meet but do you know what you want? Like, how long do you want to stick around? What are your growth goals? Like, do you hate doing the back office stuff? Do you want somebody who already has that infrastructure? So there's a lot of questions, where obviously I'm biased, but I think you should hire an advisor to help you, figure that all out before you go to market. Caber Hill being certainly one of them. I always say, like, if for an easy correlation with a doctor or anyone is just, would you, in real estate, would you sell your house, for sale by owner? I guess if the answer is yes, then maybe you don't, maybe your personality is not to have a broker. But most people, it's like, no, I'd hire a realtor. So, the same thing here. You really need to, hire expertise, because a lot of people, this is their baby. It's their family. They've been working at it for decades, and you really want to not only realize your equity value that you've created over the years, but you want to find the right partner too. Because there's so many people calling on these doctor groups that, I used to have proprietary calls that get great expressions like 10 years ago. But now it's like you call a doctor and they've heard from, 5 to 10 people already in some fashion that want to buy their practice. If you're a group, especially, I just advise, like, well, you can do that. I've seen other groups go, well, I've got like 3 or 4 that have contacted me, and they just kind of do it themselves. But it's exhausting. At the end of the day, I don't think, have you really chose the right partner? I mean, I think you should really look at when you got, we know 75 to 100 DSOs that could affiliate with you, and hundreds of private equity platforms that like to invest in $1 million to $5 million in Ebitda, like, platforms. So they're out there. So, like, at least discussing it and going through a process so you can feel really good when you get to a close. Getting the right partner is huge.
Yeah, those are
but
great thoughts.
There is money. Yeah.
Sorry, go ahead.
No, sorry, I was just saying, but there is money. DSOs are not your only option, but I also wouldn't necessarily discount them out just because maybe you don't have the experience with them or negative. Like, you really want to pair your culture with the right DSO that is as close to your culture as you can get. So that, that's when it works out really well.
Yeah, that's great. That's good stuff. Maybe one more question on valuation. I know we've kind of gotten stuck on this, but I think that is time well spent, because this is such a critical piece of the puzzle. And I know it's one of the topics every time we do one of these. There's always a ton of questions about valuation and such. And I hope it's okay if I offer up. I'd offer to all the attendees, if you have questions on any of these topics, feel free to pick up the phone and call us. And you're certainly the business expert here. I assume that if they have questions about their practice or their situation, that they could give you a ring.
Absolutely.
So maybe one just last question on that valuation. Sorry, go ahead.
No, go ahead. Sorry.
I was just going to say one last question on valuation. I think we can probably move on just to make sure we get coverage of some of the other topics. You mentioned Ebitda earlier, and I know we've got a wide range of folks here on the call today. What goes into Ebitda? Just very briefly, like if you have a dental practice, typically if it's owned by the founders or owned by dentists, all the profits at the end of the year end up going to the owners, right? So how do you actually measure Ebitda in this context? Maybe just a couple quick points on that.
Yeah, no, that's good. I mean, at the end of the day, you start out with your sales, so you got revenue. There can be a difference between your cash collections and an accrual basis. Typically, to me, as long as you're collecting, kind of in line with when you're giving the services, generally they should be similar. Most doctor groups, even when you get to 5 to 10 practices, are looking mostly on a cash basis. And, nothing wrong with that. But you would want, some guidance if you're getting into transactions into the future from like CPA firms and, third-party reputable that kind of at least, get a quick look at like what would accrual accounting be for revenue, because some of the bigger DSOs, like that's how they account for it afterwards. But, from a buying, it's easy to understand cash revenue. So that's, to me, that's a big thing. There's kind of, there's multiple things in the P&L, so I won't go through all those that on the expense side, but I will lump them into some main categories. First you have salaries and benefits. Typically I'll see sort of anywhere between sort of 50 to 55% of your revenue is in that category. Now, a lot of doctors will talk more on just general overhead, and they talk about that without their salary in there. So they're talking about way different numbers. When I'm talking about 50 to 55, if you're a doctor and you're chairside and you're doing $1 million, you need to assign yourself a value for what you're doing, whether that's $300,000 or so as far as compensation goes. Because some doctors might not pay themselves that way. They might pay it through distributions, or they just add it back. And I'm like, well, a buyer, whether they're paying you or they're paying another dentist, like you have to have a reasonable compensation in there for, the main doctor. So, you have to value everybody's services. It's probably the biggest one that, some people, shocks them. But you need to get that there. So payroll is a huge area. That's the number one, like just expense. This is a people business, right? And probably one of the hardest areas to change in integration without disrupting the business in kind of a negative way. So if you have a really, 70% of your revenue payroll and you've been given a raise to the office manager for 35 years, $1 a year, and she's 40% above market, absolutely understand that because that person was, crazy valuable to you over those years. But if it's a DSO or anyone else, they're like, well, we still need some profit at the end of the day to either invest back in the business or invest for growth. So, you either have to, change out that person and get a lower comp, or it's just like you're not going to buy it because if the office manager's got to stay, you might not be able to make financial sense. I mean, that was just like one example, but payroll is a huge area. And, after that expense, you've got, facility costs. And kind of on a base and CAM sort of thing, anywhere sort of between, 4 to 6% total, repair and maintenance office, property taxes, insurance on the building, or, property and contents, that could be 7 to 8%, in higher like in areas of Texas that I went into and areas in New York, that it was much harder. You just had to have more revenue to get that percent of revenue because the, per square foot pricing for real estate was a lot higher, so you could easily be 10% of revenue. So, and then the, after that, it's drugs and supplies and labs. Most common, and those are the most common that everyone's familiar with, and there's buying clubs, and the DSOs get better pricing and stuff like that. So, national averages are 6% kind of for each of those. If you're in the DSO, you're getting, kind of 4% or less for each of those. So you're at about 8%. So there's there could be a lot of savings there, and especially if you're doing a shared equity value, shared equity, you're continuing to invest equity afterwards, you're really going to benefit from the ability of like a DSO to have better pricing there. In most DSOs, it's not switching the formulary or it's not switching labs or anything. It's or maybe it is, but they're not really switching quality at all. And on the drugs and supplies, it's like it's usually the same gloves or the same whatever. Like, so they're not switching; they're just getting better pricing. And so that's a big area. And then the rest, advertising and marketing, like what you do there, that could really vary, but somewhere between 2 to 4% is pretty good. You're still driving the business. If it's zero as a buyer, I sit there and go, ooh, there's a lot of opportunity there to increase revenue. You haven't really marketed. And then the rest of the costs are just all your office supplies, different things like that, bank fees and stuff. And that could be another, kind of 6 to 8%. So I didn't really add those up in my head, but at the end of the day, if you're a GP hygiene practice, your kind of practice level EBITDA, like ignoring any DSO expenses, which would be like the CEO or non-chair side or a CFO or a controller or accounts payable, ignoring all of that, you should be 20 to 25% margins there. And that, at the end of the day, is kind of like your practice EBITDA. And then, if you're in a DSO environment, the DSO expenses themselves, depending on the size, could be anywhere between sort of 5 to 10% of revenue. So at the end of the day, a 15% margin in a GP hygiene-oriented business after DSO expenses is a good is a good average EBITDA margin. Once you get into like ortho, you're going to have higher margins. And some of the other specialty work too, depending on how you do your business, you're going to have higher margins. So, adding those specialty services within your organization can help improve your margin as well, and very good avenues. So I hope that explains a bit like what is EBITDA specific to like dental practices.
Yeah, that's super helpful, I think, especially for those who don't really have any background on what Ebitda is as just a general concept. I think that's helpful just to understand how an investor would view it. Maybe what we could do is let's click ahead, if that's okay with you, Kurt, and maybe we could just say a few words on transaction process. In particular, kind of getting ready for a transaction and what are some of the things that you go through. And then we can do a little bit of an anatomy of a deal in the time we've got left just to give people a sense for what the process looks like. But if you want to kick it off, I think we can.
That's great, Bart. I'll say, before just jumping into that, I'll say one other thing I think is somewhat impactful as to the current climate right now that also really got highlighted as part of the pandemic. And that's one, like some of the specialty groups like endodontists and oral surgeons, like specific groups, like they're highly sought after right now, and their valuations compared to others tend to be on a multiple basis a little bit higher right now. And part of that's the fact that, these are the ones that, yes, they lost some revenue during the shutdown, but they didn't go to zero. They had the emergencies, they had that stuff. And it's just kind of interesting because like private equity groups would look at that and go, the 3-month shutdown really affected dentistry, which should have been recession-proof, and really has been, other than a pandemic, I guess. But, the endo and oral surgery being open has spruced up a lot of interest. So there's a lot of kind of, buying and consolidation there where that wasn't even there 5 years ago. And to another extent, like things like there's other avenues, I think, for those investors that are comfortable with it, like there's capitated models. And I'm not saying 100% capitated. I just say they have capitation or, DMO, the dentist version of HMOs in healthcare, in their practices. And you look at the ADA trends, and that percent of capitation been going down year to year to year to year to year. It's been more PPO and fee-for-service. But, the capitation kind of highlighted, like, they didn't hold on as much as endo. They still shut down, but they had capitation per member per month checks coming in every month during that shutdown. So they, still had some cash. So it did highlight to some buyers where they were like, ooh, that's at least a partial mitigator. Same thing with orthodontia, because you usually pay over like a 24-month people's period, the treatment period. So a lot of people are still paying during those 3-month shutdowns. So ortho has been hot, in the last few years, but it's even, hotter just because of, a little bit of that being highlighted, like, oh, it's at least a little more recession-proof from a cash perspective. Like, the cash is still coming in, even though you were largely shut down. So hopefully that's helpful. So, yeah, I'll talk on trying to look, are we on? So transaction process, I'll say a little bit here. I know we were diving in deep and we're running out of time. So, it's really important. If I think about the whole process, I usually tell people, like, at least give yourself like 6 months. So, a lot of people are worried about, like, what's going to happen with taxes and stuff, and they want to sell this year. And I'm like, well, if you want to sell this year, you need to, like, if you haven't started, you got to really start thinking about it now. Because there will be, just like in 2012, there was kind of a big spike, especially going into the fourth quarter. And you know what? At the end of the day, there's a limited amount of advisors, especially on legal and quality of earnings and stuff too. And they're going to get busy in November and December. So, like, the earlier you start now in engaging those advisors, the better you get a deal done. But the 6 months is like the pre-transaction process could take anywhere from sort of 1 to 3 months, depending on where you're at in that. And I think you really want to, you want to hire a few people. You want to hire legal, as you guys are. Like, you want to get that involved, and especially really around, like, if you're a DSO or a group and you're, $2 million Ebitda plus with multiple locations, you want to make sure to have that structure right, especially if you're considering not just DSOs, but, other private funds, private capital as potential buyers. So, DSO might be able to just absorb you into their structure, but, a financial buyer cannot. So, like, having the DSO portion, structured properly, which I think you'll go over a little bit, Bart, it's kind of a big thing certainly on the legal side. And I'm on the business side, but what I will say about legal is I don't usually advise people to go with their local, lawyer they've had for a lot of years. They may have some transaction experience, but if you're going to go for highest valuation, trying to find the best partner, like, you really need people that know dental, and you need people that get deals done versus deal killers. I could elaborate a lot more on that, but I won't. But get deals done versus deal killers. Like, if every deal point is important, none are. So the, and really that pre-transaction is like, you really go through, look for low-hanging fruit too. Are you leaving, for me, it's like, are you leaving some value on the table? Like, is there some low-hanging fruit you can fix in the next few months to, potentially better your business and, better the outcome? Whether it's 3 months or 6 months or you want to sell in a year, like, have somebody look at it and advise you on low-hanging fruit. Because at the end of the day, Ebitda is ruling that calculation, and more people are trying to just do what they call add backs, pro forma add backs, and they say, oh, this cost is not going to be going forward. And that's where I see a lot of different Ebitda evaluations when people start doing that. You know, they add back the entire back office or something, and I'm like, well, are you all going to leave post-transaction? No. Well, you can't add them all back. Like, you have to have a value associated with that. Like, a DSO might be able to absorb some of that, but, like, you got to take a really realistic look at that. Because the last thing, at least in my opinion, you want to do is get in an LOI, get in this stuff, and have this stuff come out in diligence. You get exhausted, you get beat down, it gets renegotiated, you get the close, the buyer's not really happy, seller's not really happy, and you've started out wrong. You know, you'd rather start out right with the buyer happy and the seller happy. So that all, to me, starts with pre-transaction. And then the transaction process, like, you know, letter of intent, you know, after you've got a lot of people, you get that signed up. You typically give that exclusive to one group. And an LOI to close process, you know, could be anywhere from 60 to 120 days. There's some being very aggressive, trying to do 30 days, but that's few and far between. But somewhere between 60 to 120 days for that.
Yeah, I don't think we ever see anything close that quickly, even if everything just goes perfectly. Let me ask Kayla, what are some of the things that you see just working with clients in terms of preparing for a sale or preparing for partnering with a DSO or merging practices together or things like that? What are some of the things that our clients or sellers ought to be thinking about in advance of that process to just help anticipate problems in the future?
Yeah, Bart, thanks. I think that one of the biggest things are some of the things that Kurt has touched on. So picking the right advisors, and then through that process, when you have those people, they can guide you through some of the key questions leading up to the LOI and, quite frankly, through the LOI. One of the things that we see people considering more and more that we did not used to see people consider is sell-side QOVs. So to the extent that you are a larger business and you are going to market through a bid process, we do see it being more common that you essentially do a QOV on yourself so you know what to expect. And even if it's not formal, it might be informal through, for example, an investment banker or another advisor that you have. The other thing that we often see people doing is doing a lot of pre-closing tax prep. So I know Kurt mentioned this a little bit earlier, but improperly structuring your transaction from a tax perspective can really eat into compensation that is proceeds that are taken home by the owner or physicians. So especially to the extent that you are currently structured with your entity as a C Corp, you're going to be really, really careful to see what the implications of that are going to be for the dentist owners. You often have to do significantly different tax maneuvering in order to make a transaction work. S Corps are less so, but there are still often some restructurings that have to happen to make get tax deferred treatment on your structure. So that's just a couple of things to think about. And then one that I think is one of the most forgotten situations is not just your owner dentist, but also your associate level dentist and how they may view the transaction and how they may impact the transaction. So in many situations, they may not be required to consent or really participate in the sale, but they are contributing a really significant amount of revenue to your overall Ebitda in most situations. So to the extent that you don't have significant non-compete, significant buy-in with those associate level dentists, then you could be in a situation where through the transaction, they don't want to stay on board with you, and therefore they could actually reduce your purchase price if they indicate that they're going to leave. So one way that we've seen clients and then also sellers and buyers incentivize that not to happen is by doing certain types of retention bonuses, finding ways to cut associate physicians into the ongoing future rollover equity component of the transaction. There's a lot of exotic methodologies that can be used, but it is probably the most common thing that I see people do wrong that starts to derail their transactions.
Great. Thanks. And just to pick up on something that Kurt mentioned a minute ago, you kind of have to pick your spots in any kind of a transaction negotiation. And I think he said, if all of the points are important points, there are no important points. I think that's exactly right. And this will probably be the last slide we have time to cover today. But can you talk a little bit about some of the key negotiation points and some of the things that we focus on? And then Kurt, we'd love to hear from you if you have anything to add on just, key negotiation points or things that have absorbed an inordinate amount of time in recent deals that you've worked on.
Yeah, definitely, Bart. And I'll just try to hit on the things that are on this slide that we already haven't talked about a lot. So one of them is rollover equity versus cash consideration. Kurt touched on this briefly, but in any DSO transaction, or nearly any this day and age, we almost always see rollover equity. And so usually between 10 and 20% of the overall purchase price will be taken by the owner dentist and then reinvested in the DSO. And so that's just something to be considered when you're looking at a potential transaction, because that equity is often a necessary part. There's often a lot of resistance to allowing dentists to take 100% cash consideration deal because of the lack of future investment, like Kurt was talking about earlier. We talked a little bit already about the tax structuring, so that's very entity specific. So I would highly encourage you to talk to your legal counsel, talk to your accountants about the best way to minimize tax impacts, because it's very, very important, especially this year. Governance rights and operational decisions. So if you are selling a majority position in your practice, you should have managed expectations about how much control that you will be allowed to maintain over the non-clinical aspects of your business. But there are some really key things that we often see people asking for in the governance documents, notwithstanding the fact that they do sell a majority. So one of those things is anti-delusion rights. So your equity will not be diluted by issuing and bringing in other people without giving you the opportunity to purchase additional equity. We also see often provisions that say you'll never be asked to sign a more restrictive non-compete than you signed during your initial transaction. And there's a litany of other items that I won't go through, but it's something to consider and definitely talk with your legal counsel about in detail. We've already talked about a lot of employment compensation, but restrictive covenants are very, very important. The things that they typically turn on is what is the scope of them? So how broad are they? What do they cover? And then when are they released? So under what circumstances will you not be bound by the non-compete? So for example, if the business terminates you without cause, that'll often be an item that you really want to push on to get released if you can, and then many buyers are going to resist that heavily for a variety of reasons. So that's just something to talk with your legal counsel on and think about. And then the last 2 points, which I'll hit in the last minute here, are just around indemnification and escrows. So at a very basic level as a seller, you're going to be asked by the buyer to retain certain liabilities that arose prior to the transaction. And that is very typical. It is very, very unusual that you would ever not have that obligation, except in some very large deals that are going to have insurance to cover that liability. So what you're really looking at is trying to limit, to the extent possible, your liability post-closing for things that happen pre-closing. And you do that in a number of ways with your legal counsel, but it is something to really focus on and understand, because there's many situations in which sellers that we have seen don't focus on those elements. They're somewhat a theoretical risk, but then they can become real economic risk in the future. And so that's all I'll say about those briefly. But like Bart said at the beginning, we're always happy to talk about these topics more offline and go through anything that would ever be helpful.
Thanks, Kayla. And I'm afraid we're out of time for today. I appreciate the robust conversation, and this has been really, really good. It's usually a good sign when you spend more time, addressing questions that folks really have asked and have specific interest in, and don't make it all the way through the slides. But one thing I'll do is we'll plan to send out the full slide deck to everybody, just so you've got the full kind of stack of information in case you've got questions, and just so you've got that on hand in case you want to use it as a reference in the future. But thank you, everyone, so much for joining again. Kurt, thank you very much for joining us. We always appreciate your expertise, and Kayla, nice job. Thank you very much for all your work here too. So everybody have a nice day, and thanks for joining us.
Thank you.